A quick audio test. Audio test 2. Audio test 2. Hi folks, those listening already, let me know if you think the audio levels are okay now. Thanks. Final audio test. Final audio test. Well, here we are, folks. Welcome, and nice to see so many in the chat before the show started. Great that you can hear me. And just to explain, the studio is sort of half built, but I do have a few issues at the moment. And my main streaming device is called a Yola box, and for some reason the Yola box told me that there was no audio on the stream, which is a bit worrying, really, seeing as it's all about audio, really. I mean, the pictures are nice, but the audio is critical, so hopefully everybody can hear me. I have got a different setup, better, maybe different mic. Tell me what you think. Hope the levels are fine, and looking forward to having this conversation around mortgage stress and some economic data today. And so just before I get started, I will just say, of course, this is Martin North from Digital Finance Analytics. So thank you very much for spending some time on a Tuesday evening with me, and commiserations to your winter. I know it's cold down there. We've had a very nice summer so far up here, 25, 26, 27, about a month of blue skies and sunshine. Rained a bit today, but nevertheless it's pretty good. So lot to talk about, and what I want to do is break the show into three pieces. The first piece, I'll give a little bit of background with regard to what I've been doing, particularly about the studio. Then I'll move into a conversation about the economics and what we're seeing and some of my stress analysis. And the third part will be potentially looking down at postcodes. If there's a particular postcode you'd like me to explore, that information is available. And of course, because I'm running the show myself, I won't necessarily be able to answer absolutely every question at every point. And just a couple of people said the audio is low. I can certainly ramp it up a bit more if you'd like me to. That's not a problem. Tell me whether you think that's better now. I just don't want to go over the top and make it clip. Yeah, It is directional, but I should be able to make it work. I'm just, as with everything, we are playing with it as we go. See, that might be a bit better. Anyway, tell me what you think. So, before I get started, the new doggy cam is on. And so, let me just bring up the new doggy cam. So, this is Luna in the basket. Unfortunately, Meteor decided to go off and sit just outside the basket. Too much gain, too loud. I can't win, can I? So, I'm going to turn it back down again. So, I think I probably had it right. Anyway, there you go. I'm going to turn it back down to there and see whether that works. And still stalling a bit. Go back to where it was. Okay, there we go. You see? Loud, distorted now. Yes. Let's see whether we go back. Okay. I think I had it right. Okay. See whether that works. As with all of these things, we can... Sound is worse. Louder. Way too loud vibrating. Yeah, you see, I can't win. And because I haven't got my meter working, it's rather fly by the seat of my pants at the moment. Anyway, let's give that a go. I had the sound right at the start. Yeah, I thought I had, but anyway. Okay, so there you go. There's the doggy cam, and it's basically not the treble, says Cookie Boy. All good now? Good. Okay, well, we'll leave it at that and see whether we can make it work. I'm using a different microphone. My other microphone is still to be unpacked. Sound was right initially. So, you see, I can't win. Okay. Anyway, let me go back to where I was and bring up the intro, and just want to sort of quickly go through a few slides, which is on the economics and everything else that's going on at the moment, because there's a lot going on, and I think a lot of people are just catching on to some of the themes that are actually quite important. So let me bring up and just remind you, of course, to start with, that we do actually have some house rules here. We don't provide financial advice nor legal advice. This is just a general conversation. Do play nice in the chat room. No racial slurs, please. There were a couple of posts that didn't get through because there was some swearing, so please don't swear. It makes it a lot easier here. The auto moderation processes are actually quite good. This is as of 20th of June if you're watching in replay, and if you'd like to get my attention specifically to ask a question, use @WalkTheWorld. That'll make sure that I see you. And also I've enabled the super chat so that if you want to make a contribution, feel free. I really appreciate it. Or indeed, if you'd like to get your question top of the list, you can do that. And just in terms of the rates, this is quite interesting because, of course, the ECB has lifted the cash rate this last week. It's a bit behind the other at the moment. Shh! The dogs are growling. No, be quiet. There's nothing to see. So it's interesting that the rates have been rising quite fast, and of course more are expected, I think, later. And interestingly, in the US, the price pressures have eased a little bit, but the core inflation is still above target, and the Fed, of course, who paused just for a month probably, will probably lift again, because inflation is now stickier for longer. And the risk curve is also higher, so this is actually the credit risk gauge, which jumped after the last rate forecast came out last week, and that basically means that the markets are getting a bit more twitchy, and so there's a real disconnect between what the markets are actually saying, because stocks are quite high thanks to the AI stocks, but in fact some of the broader risks are actually quite strong. And by the way, interestingly, of course, the US is about to launch a significant cash raising following the debt ceiling being sorted out. And interestingly also that a lot of owners of US securities are foreigners. Because of the exchange rate and the strong dollar, that might be a problem. So the question is, will there be a liquidity drought? And if there is a liquidity drought, could it actually create issues with regards to the financial system? And in fact, it's interesting to note that the Bank of England is stress testing the financial system here because they're worried about some of the liquidity pressures that could be in the system. Now, interestingly, inflation expectations are pretty high around the world still. In fact, this is German data from Deutsche Bank, and the fact is that people are still thinking inflation is going to be a lot stronger than their target. By the way, though, China is weakening. You look at the output and the retail sales, or indeed if you look at the producer price index for China, and so there's a big debate going on as to whether China will do more stimulus. They seem to be in a very different scenario compared with some other countries. But nevertheless, the bottom line is that if China is going to throttle back or stimulate selectively, they could focus more on local economy rather than maybe importing more raw materials to build stuff, because of course they've got 20% youth unemployment and a bunch of other negative scenarios in China. So all those things I think are in play at the moment. Now, in comparison, Japan, of course, is doing quite well. They didn't lift rates. They've been sitting on very, very low rates for a long, long time. Inflation is coming back and the GDP is quite strong. So it's interesting that they've zigged while everybody else zagged, and so far their results are looking okay. But the question is, do they need to lift rates later? If they do, how does that play out? Now, coming to the Australian situation, the RBA minutes came out today, and there was basically quite a long discussion about should they hold, should they not hold, and they itemised the items on both sides of the balance sheet. Inflation is strong and sticky. On the other hand, households are under pressure, and some firms too, so they weighed it up and said we're going to lift, so they did. And they did affirm that they are continuing to chase inflation, and they want it down within a reasonable time frame. And of course they argue that an extended period of high inflation will distort the market, but there's also a lot of uncertainty, etc., etc. Members affirmed their determination to return inflation to target and their willingness to do what was necessary to achieve it, which is pretty much consistent with what we've seen insofar that the RBA is expected probably to continue to lift rates. And just to put that in context, this is actually days since the first rate hike, and you can see there that the May cycle is the fastest pretty much ever. And of course some recession warnings are now out there within the next 12 months. I think it's quite likely we'll see a recession in Australia. Households are beginning to become under pressure, and there's a bunch of other stuff going on which is making it more difficult. And here's just a snapshot from the CBA highlighting the fact that whilst the roll-offs are actually happening for the fixed rates, the peak is still to come, and you can see there that the proportion and value are definitely going to rise. So we're not out of the woods yet, and typically it takes 12 to 18 months for the full effects of monetary policy to filter into the economy, so there's effectively more tightening built into the system, and yet the RBA probably will continue to lift. By the way, arrears are rising. This is the latest from the prime spin data from S&P Global Ratings, and you can see there that the arrears, this is mortgage-backed securities, so this is the cream of the crop. 1.73% in Western Australia, 1.3% in New South Wales, 1.55% in Victoria, and 2.71% in the Northern Territory. NT, of course, is a very small sample, so maybe not that critical. Now, the other point to make is that the interbank cash rate has moved dramatically. So this is on the left-hand side what the interbank cash rate implied futures was last night, as at the 19th, and you can see that it's peaking now at 4.58 in November, and by October, November next year, 4.17, 4.12, which is higher than where we currently are. Cash rate, of course, being pretty much where we're going to end up. But if you look at the previous implied futures, this is from the 31st of May, so this is under a month ago. You can see there that in October 24, 3.48 was the expected number in October, and the peak was only just at 4. So you can see here another 0.5% wired in now to the markets. Now, of course, the markets consistently get this wrong, but I think it's quite an indication. Now, just to underscore this, housing debt servicing costs have gone through the roof, according to CBA. Looking at the share of disposable income, it's rising, and of course the total amount outstanding is very significant too. And the debt servicing costs is very much interest rate driven. So effectively, you can thanks for the Jason. You'll turn my mic down a bit more. Okay, I'm turning it down slightly more. Tell me if now you think that's too low or whether it's going to work. There we go. So that's hopefully going to be okay now. I don't know. I can't get my mic right tonight. I haven't got my meters to explain. The meter's broken on the streamer, so I can't tell what the levels are like. So I am definitely flying blind. So back to the chart. The interest rates are definitely higher, and the interest payments, of course, are higher as a result. And the household savings ratio is falling dramatically. It's now below the 10-year average. Of course, people are raiding savings to try and get by and to make their payments. The other point to make is that discretionary and essential consumption have definitely crossed over, so people are spending less on choosing to spend and more on the things they have to spend on, and that's not necessarily buying more stuff, it's just they're having to pay a lot more stuff, and of course food inflation is very, very high. Everyone's now saying better, so hopefully that's good. That's pretty close to where I was before I started taking the gain higher. Anyway, sorry about the audio, but I know that the levels were right to start with, but as I say, I can't see them on the meters at the moment, so I apologise. And just in terms of those deposits and those savings, this is a very killer slide insofar that it shows that in fact older households, those without a mortgage, those with maybe shares and other savings, have quite a lot of savings still, but younger households, the cohorts from 15 to 24, 25 to 34 and 35 to 44 are actually struggling, and in fact 35 to 44 they're actually in deficit, and that's a very significant factor. Still too high, says Drew. I'll go so quiet that no one will be able to hear me at all. We'll see that. Okay, we'll try that. There you go. Okay, see whether that makes it better. And one other factor, of course, is to bear in mind that more people are working multiple jobs. That's a very significant factor in the scheme of things. More people have more part-time jobs, and particularly women, particularly in the healthcare sector. And of course, overall the economy was slowing 0.2%, and the hours worked rose. So people are working a lot longer, and it's interesting. Gain is through the roof, says Drew. Just adjust your own volume. Yes, I think it's pretty much right now, so I think I'm going to leave it where it is. So you might just want to tweak your own volume at your end, and hopefully that will then work. As with all these things, there are lots of different elements, but it's definitely peaking at the moment about -5, which is roughly where I should expect it. Okay. Okay. Now, I reported the latest financial stress, mortgage stress data the other day, and the ABC did a very nice piece on it. If you've not seen it, Nathan Morris produced a lot of information, a lot of charts and everything else, which was pretty good. And Roy Morgan also came out and said mortgage stress is rising, significant rise, and is expected to continue. So it's not just me, other people are saying it too. Okay, Greengrass says a lot better. So peak. Okay, now let me move on to the next part of the show, and just to explain what I want to do now is just to go through my mortgage stress analysis and give you a bit of an update. Many of you will know the methodology we use and why we do what we do, but nevertheless what I want to do is just quickly go through that so everyone's on the same page, and I'm going to share you the high level data, and then we can have a broad conversation after that. So we model continually, we get the surveys weekly, and we update our core market model at the end of each month based on the information. And the data shows us quite a lot of good stuff in terms of what's going on. Of course, 52,000 sample, 0.5%, so it's quite a big survey. We can slice and dice the data lots of different ways. For those of you who've been on the show for some time will know how we can do that. Thanks, Jason, for that. Appreciate. And audio is much better. Be nice once you get set up. Audio was mad. Yes, I'm sorry about the earlier noisy audio. I was going on the earlier prompts, and as I say, no meters. Hopefully fix them for next time. In terms of the core market model, we also, of course, do have the ability to look at scenarios, and scenarios are quite important at the moment, of course. That means we look at mortgage stress, the trajectory of prices, the buying and selling intentions, the migration data, the economic data, bang it through the core market model, and that then allows us to look at the scenarios for different household groups and postcodes. And by the way, if you are interested in a one-to-one conversation in detail about a postcode, I can't give you financial advice, but I can talk about the underlying trends and looking at my data. Takes about an hour to have a Zoom conversation or a phone conversation, and we have to charge a fee because of the work involved. It's available booking 3 or 5 weeks ahead, and if you want to contact me via the blog, details are below. Now, on stress, we define stress in cash flow terms, money in, money out. The 30% of income proxy is a very bad one these days, so I use a cash flow measure, and if you've got more outgoings than income, then you are basically in stress. If you have a mortgage stress, in rental stress. And investors with cash flow pressures are identified as stressed investors. And we can also look at it at total financial stress, which is an aggregate measure across all households. And we can talk both in terms of percentage of households and count. I think the latter is better, because if you have a very small postcode with significant levels of stress, the percentage would be high, but the overall impact would be quite low. Okay, mortgage stress. This is now the critical story. So, as at the end of May, we had rental stress shooting up to 62.01% of those in the rental sector. That's the highest it's ever been. And you can see there the long climb since May 2007-08, which was, of course, the previous global financial crisis. Went down a bit, but been climbing, and is much stronger than it was before COVID. Looking at mortgage stress, then that's higher at 48.4% of households, and back in February 2020 it was 32.9%. So we've got new records on both mortgage stress and rental stress, unfortunately. And the household data for household debt is also rising according to the RBA. This is slightly out of date now, they are a bit behind us, but the fact is that this is understated because, of course, only 1/3 of people have a mortgage, but they count all households and small businesses in this number. So here's the data for May, and you can see immediately that the 48.36% of mortgage stress varies across the states. Look at the percentage column, and it's interesting that we've got very high levels of mortgage stress in Tasmania, although it was slightly down this last month, and in South Australia, as well as New South Wales and Victoria and Western Australia. And the Northern Territory has lower levels of mortgage stress, but that's a very small sample, so it may be less reliant and relevant. Rental stress is also quite high, and you can see there that 62%, and just to be clear, 62% translates to 1.9 million in rental stress. The 48.36 translate to 1.8 million households in mortgage stress, and there's about 9.7 million households overall. Not, of course, everybody borrows, but it gives you a bit of a sense. Got some stressed investors, not dramatically, but 21%, and that's about 641,000. And so overall financial stress, which is essentially an aggregate across the board, is 45.27%, and that is overall 4.4 million households. So just under half of all households in Australia are now finding it difficult to make ends meet. Of course, the other half are in a much better position, as I showed earlier. We can look at it by segment as well, and as normal, young growing families, first-time buyers, of course, are there, 88% in mortgage stress. The battling urban disadvantaged fringe, also very high. I've highlighted those in yellow. For rental stress, some of the more elderly, particularly the wealthy seniors, they're the ones relying on future cash flows from investments, are actually finding that they've got more difficulty than previously, but we've also got first generation Australians, the multicultural establishment group, first generation Australians at 70%, and mature stable families at 69%. So across the board it's pretty worrying. And it's worth also highlighting the fact that some of the pressures on the rental sector by segment are also flowing over into a broader base than previously. And by the way, just going back to investor stress, it's worth highlighting again that exclusive professionals and young affluents are the two segments that have the highest amount of investor stress. These are because they have a mix of investment properties, some of which are not performing at the moment. Despite lifting the rentals up, the fact of the matter is they can't do it sufficiently to be able to deal with the rise in interest rates. And overall financial stress there is at 66%. Now we can quickly just look at mortgage stress by postcode, and the Campbelltown area 2560 is stack ranked the most count, more than 12,200. Then another Liverpool postcode 2170, and then we go to Western Australia and Tapping, and then we come back to Toowoomba up in Queensland, in regional Queensland, and then several Victorian postcodes: Roxburgh Park, Narre Berwick, Harkaway, Pakenham. They're all high growth corridors, of course, around Melbourne, and are subject to a lot of recent buyers. And we go back to Camden in New South Wales, and Riverstone, and Marsden Park, and then Ballarat regional area, and then across to Victoria again to Hobbs Crossing, and then Point Cook and Werribee, and then back to Western Australia again. So you can see how broad some of this stuff is. Look at rental stress. You can see there that Melbourne, centre of Victoria, of course, 3,000, has the highest count, more than 12,000, and Liverpool follows, then Toowoomba, then Greystanes and Wentworthville in New South Wales, and then areas 2770 around Lethbridge Park, Mount Druitt, and then we go to the Southport area of Queensland 4115, and then back to Zetland in New South Wales, Hoppers Crossing and Tarnit in Victoria, Campbelltown in New South Wales, up in Queensland, Coomera, Bundaberg, of course, another regional area, Ipswich, another regional area, and Blackdown, of course, as well in New South Wales, and Gosford on the mid-north coast, or the central coast, I should say. So quite widespread, quite big numbers. The stressed investors are also very much struggling. So some of the most interesting ones, Narrowburn and places like that, at Crow's Nest, Greenwich, are actually where a lot of houses are for rent, but they are mortgaged, and therefore the mortgage has grown significantly compared to the rental. Then Melbourne, of course, the other side of the story we saw before, Wentworthville, Southport, Strathfield, and towards Western Sydney, Fortitude Valley, Queensland, and so it goes on, Bundaberg again, and a few others too. And finally, overall financial stress, which is the aggregate. Liverpool, New South Wales takes the prize, then Queensland and Toowoomba. Very significant pressures there, with more than 24,000 households there in difficulty. Campbelltown with 23,000, and then Roxburgh Park and Craigieburn in Victoria, Hoppers Crossing and Tarnit, and then the centre of Melbourne, and then Mount Druitt, Ipswich, Cranbourne, another of those high growth corridors, Derrimut, Point Cook, Wentworthville, then Tapping, Ballarat, Pakenham, Blacktown and Southport. So you can see how it's all playing out. And I guess my point is that this is obviously a snapshot in time, but if you've been following my shows in recent weeks and months, you'll see that that growth has been quite significant. So as Donna said, it seems to me all the housing estates of the 2000-2010, so a lot of the more recent construction, and a lot of people who bought, of course, particularly at the top of the market with very low interest rates. Remember, the politicians were saying buy, now's the time to buy, post-COVID as well. So I think it's more recent as well. Interestingly, a lot of first-time buyers who bought are the ones with little equity, and they have a real problem, which of course is part of the story here. So that's the sort of the base story, and what it means is that ahead, I think we're going to see more people getting into difficulty. 3 points. One, the RBA is probably going to lift rates again, and I'm not sure exactly how and when and how far, but the chances are it'll be significant. Secondly, households' income is still not growing relative to inflation, despite the higher pay rises and despite the relatively low unemployment we've got. I've said earlier on that more people are actually working multiple jobs. The third is that the pressure on those higher rates will put more pressure on the mortgage sector in particular. Of course, we've got the fixed rate cliff, I showed you that earlier on, and so we've got more people facing into a problem. And now the banks have been quite flexible, so they are actually extending their mortgages. They're actually allowing people to refinance if they've got equity and put the loan over a longer period, so the monthly repayments drop. They're also allowing people to draw equity out sufficient to pay the mortgage for the next year or two, which is trying to give a sort of a short-term sort of bridge. But if rates stay for longer and higher as now we expect, the question is, will that be sufficient, or will ultimately this work through? Will we actually get into a recession? And of course there's a big debate about, well, in an inflation environment where inflation is still burning much stronger than it should be, is there any capacity for the RBA to support in some other way, or will they still keep rates high? And there's an expectation amongst many in the markets that they will cut, and cut sooner than they're jawboning. But then, of course, if inflation is so strong, can they do that? Will they do that? And that's another factor in the whole of the story. I can't win. Turn up the volume, says George. I can't. Some people saying high, some people saying low. So may I suggest you adjust the volume you're on? I'm going to leave it where it is at the moment because I think it's best I can do at the moment. I've turned my volume down too drummy. That's interesting. Well, it's meant to be a reasonably good microphone, so I don't know. So now let's go on and just do a little bit more. So one of the things to say is our scenarios is a way of thinking about the future and what may be happening. We run 3 scenarios: the best, and the worst. The best case is that rates don't go any higher and fall next year. I think that's unlikely. No recession. The base case is that rates go to 4.35, which means you've got higher mortgages. And of course, the fact of the matter is that inflation is going to stay above target until 2024. Maybe we'll escape recession, but that's getting more and more unlikely. And the worst is that rates rise above 4.6%. They stay high into 2024, along with inflation and wage growth stalls due to recessions. Rates perhaps will fall later. So it's quite significant what we're seeing here. So there's some very important different scenarios, and if I then give you a bit of a sense of what that means, this is just an example, but I can look at it down to the postcode level, and I can run the scenarios then for each postcode to see where we might get the price growth or price falls. And whilst there has been some price growth in some areas recently, we're still down from recent highs, of course. My expectation is that the higher interest rates that we're seeing here will actually create more pressure later. So, interestingly, Jason said there are calls to impose rent freezes. What does your data suggest? Could it actually work? Well, of course, rent freezes have been used before, but the question is, how do you freeze them? If you're going to freeze them, are you going to make the investors pay, or is the government going to pay? So that's the first question, because of course property investors are actually in difficulty at the moment simply because they actually have a lot of pressure on those interest rates. So in a way, a rent freeze is a problem when the bulk of rental properties are delivered by the private sector, who are themselves often mum and dad investors, others perhaps with more properties, but they're also reliant on the same sort of cycle and on the same situation. Now there is, of course, a whole bunch of discussions about housing policy or not, because of course the housing fund was sort of parked until October. Albo did mention the 2 billion I should say, for social housing. Of course, the social housing strategy looks to me to be allowing people in the States to use some of that money to buy property that's already in development and use it rather for social housing for a period, maybe 10 or 15 years or something like that, rather than use it for this private sector. So this is effectively a builder bailout strategy, in my view. It isn't going to do much to actually help the true situation. And it's pretty concerning, I think, with what's going on. So what do we do? And how does it play out? That's really the question. And of course, it goes right back to my point about where will the story fall with regard to the question of rates. Now, it is worth saying, I think, that the scenarios are looking quite concerning over the next 3 years. So basically, in most cases, in net terms, I don't think there's much equity growth in property. Whilst we've got migration coming in, 700,000 over 2 years, and that should put a bit of a floor on things, the higher rates and the broad economic pressures and the risk of recession are all playing against it. So that's really the game we've actually got at the moment. And as to how it plays out, not sure, but it's not looking very positive. And it's interesting, of course, that a number of the bank economists are now talking 4.6. Some people are even talking about 5% as the cash rate. And of course, that would have a significant impact on households, particularly those with little equity and those maybe who are facing a refinancing situation. So it's a very, very significant problem for the government, of course, because there's a political aspect to it. So what do you do about the politics, but also the social and economics? And the Reserve Bank in their minutes did talk about slowing economy and slowing household spending on those things, and certainly the trends that we saw earlier on in those earlier charts show that discretionary spending is already dropping. Remember, 60% of the economy is driven by consumers and what they do. So if consumers start to go on strike, that's going to drive the economy lower. If China goes off the boil, as I showed earlier on from the data, that means potentially we have less exports rather than more. And so all of those factors are playing us into a rather uncertain future. And as for households and what they do, well, of course, the old story is this. If you've got a cash flow problem, first thing to do is understand where you are. So look at the money coming in, money going out. About half of households have a budget of some sort, the other half don't. A lot of people, of course, end up, well, really struggling because they don't know what to do. What they need to do, of course, is to prioritise their spending, and that's what they're doing. So they're looking at discretionary versus non-discretionary spending and cutting out the things that they can afford to. They're trying to refinance, and as I said earlier on, the banks are being helpful at the moment, extending and pretending. But if the rates don't come down, and remember that the rates now are just normal, this is not abnormal where they are. What was abnormal was taking the rate close to zero and then actually turning around again. So this is actually quite important to understand, that we're actually now in a situation where rates are, still relatively benign on a long-term average. They could go a little bit higher. So pull that together, and once you've done your cash flow, what do? Well, households, of course, will try and prioritise paying the mortgage or the rent. It's critical. But the bottom line is that ultimately they may have to take more radical steps. If you're a property owner and you're forced to sell, where do you go? You can't get rental property. It's not really very accessible. And if you're in the rental sector, we're seeing a number of renters in the surveys move to other places if they can get property. But of course, available property in a number of areas is quite limited at the moment. So this is a really big conundrum at the moment. Okay, so I think that's given you a bit of a flavour of what is going on, and what I might do is switch across and just share with you a few scenarios that I've been working on looking at a postcode level. So let me just, I haven't got the automation sorted out yet, just 1 second. Okay, so this is my favourite Wollongong, because I actually think that Wollongong's quite an interesting one. Of course, I know the area very well, and what's fascinating about Wollongong, put that up there, is that we've got a lot of stressed investors now in Wollongong. It's actually the most significant factor in play. The mortgage stress is not particularly worrisome at the moment, and that's despite the borrowing. Now, the reason for that is that people have hunkered down, But nevertheless, you can see here that the scenarios over the next 3 years for houses are, we're going to see best case scenario going sideways, the base case a bit of a fall, and the worst case a significant fall. Whereas units, well, they might not drop quite as far, but nevertheless there is a risk to the downside. And in the best case scenario is, in 3 years' time it might be slightly higher. So, sorry, 2050. I said Wollongong. My apologies. It should camper down. Oops. I retyped. I'll now put Wollongong in, which is the one I was hoping to do. I'll put it back to front. That's better. Aha. Okay. As you were. Wollongong. Now the reason I went for Wollongong was because of the fact that we've got this very significant issue with regard to stress. And we've got now a significant 43% of borrowers going with the disposable monthly income, 43% going on the mortgage and 34% on the rent. So it's a real problem. A lot of rental stress, a lot of financial stress. And over the next 3 years, you can see here how this plays out with, even in the best case scenario, a bit of a fall, worst case scenario, a significant fall. So this is a bit of a bellwether, I think, looking at some of the regional areas. And by the way, it's also worth highlighting the fact that net investment yield, so that's after the costs of the investment property and interest on the property, is actually negative. And we're seeing that now in a number of places, so it's pretty significant. Jeff says, I guess things are going to get worse for several years, really bad for some people, and crime and homelessness. Yeah, I mean, I think that's part of the issue, that it is going to be a problem for not just the next few months. I still am amazed how many people are saying, well, the RBA will cut rates and magically it will all be solved. I'm not sure it will. It seems to me that there's a much more complex set of things going on. And the story, of course, is that very often the consequences play out over a long period of time. And all the research, by the way, shows that in fact mortgage payments and pain takes 12 to 18 months once the rate rises come through, because people can hunker down for a period and continue to manage their affairs, but at some point it does go off the boil, and when it goes off the boil, that's a problem. So that's why I think this is a very significant factor for a number of households. Now I will just pick another postcode here because I wanted just to talk a little bit about the centre of Melbourne, because it's another quite an interesting one, and I'll just show you what's going on there. So this is Melbourne 3000. You may remember that I highlighted the rental stress here, and you can see here that rental stress is at 68% in this particular postcode, 71%. Stressed investors are at 68%. So both those renting and those who are actually stressed investors are actually having significant difficulty. And again, you can see that disposable monthly income for borrowing is above 43%, for renting is at 38%. Most, of course, are units in the centre of Melbourne. And so you can see here that the best case scenario is a fall of maybe 11% over 3 years. The base case is a more significant fall. The worst case is a very remarkable fall. I think that's unlikely, but it is worth just showing the sensitivities. And I make the point also that the rental stress is despite the fact that the net investment yield is just slightly positive, unlike Wollongong where it was negative, it was positive. So it does show you that even if you are making a little on the cash flow, positive, you can still be struggling with the overall story. That's a fascinating observation. Now, if there are particular postcodes that you would like me to show you the results on, I'm happy to do that. I've got the engine up, but I will just in the meantime go to another postcode and see what's what. Why don't we do a comparison of Brisbane 4000, because of course Brisbane is a bit of a different scenario, except what we are seeing is that there is still significant rental stress in the centre of Brisbane, and of course 87% of property in the centre of Brisbane are units, and the gross yield is much better at 2.2%, but nevertheless from a cash flow perspective we still see the investor set struggling, so therefore stressed investors are actually registering, and we are expecting to see a small fall over the next 3 years, best case scenario, and a slightly bigger fall if in fact it went later. Alright, so Justin said 4227. Let me put that one in. So this is Varsity Lakes in the Brisbane and Moreton Bay area, just over 9,000 households, and here you can see that the average disposable monthly income is about 40% on a mortgage, 41% on renting, 39% of borrowers are in mortgage stress and 41% are in rental stress. It's roughly half houses, considerable number of units, and others including over commercial property. And the net investment yield is 0.8 while the gross investment yield is 4.6. And you can see here the scenarios. The best case scenario, a very small fall over 3 years, but the base case a more significant fall, and both for units and houses. So there's definitely a question as to how this is going to play out, and it's worth just highlighting the fact that the typical household census for income was 93,000, the individual said 72,000 from the ATO, and you can see there there's a lot of money going out on accommodation, so that's a story. Okay, I've got lots and lots of postcodes. There's one here, 4122. Okay, so this is Mount Gavitt in Brisbane and Moreton, and that shows 37 and 32%, so a little bit lower in terms of overall disposable income, but nevertheless the levels of stress at 47% for mortgage stress, 53% for rental stress, shows that there's quite a lot going on, and 42% of households in financial stress. You can see there that 71% of houses, 16% of units, and there's some other types too. And you can see that the gross investment yield is about 4.5, the net investment yield is positive 1.1%. Income's higher, the census at 100,000 or so. And if you look at the scenarios, you can see there that the best case is, well, pretty much flat, slight fall over the next 3 years. The base case, a bit more of a significant fall, depending on what happens with rates and the inflation data. Okay, 2640 says Stuart. Okay, so this is West Albury on the south coast, 16,000 households, and here 34% of borrowing, and the point there is that it's quite high but not as high as we saw previously. 26% of renting, so mortgage stress 20%, rental stress 74%, so it's a rental stress problem, and that puts some stressed investors there but not dramatically so. And if you look at the scenarios, a bit of a fall, even best case scenario, but a more significant fall, worst case scenario. So it is quite concerning. A lot of houses, few units, and that's the story there. So Pacini said 3977, and thanks for the super chat. Appreciate that. This is Cranbourne. Now, of course, Cranbourne is on my headline as one of the most stressed areas. So you can see that 38,000 households, 41% are actually borrowing. Sorry, 41% is the disposable income, 61% of borrowing, 24% of renting, 33.9% of disposable income going on the rental property. Mortgage stress at 32%. Rental stress at 60%. Overall financial stress at 42%. 87% of houses, small number of units. Net investment yields are negative, and you can see here the scenarios are showing a fall, even in the best case scenario of about 10% over 3 years, and that's for houses. Units are roughly similar, slightly less. And so this is a classic example where there's a lot of households quite close to the edge, but partly it's a big count because we've got a big base of households there, and overall it's 32%. So it shows you that, you know, you've got to be a little bit careful with some of the numbers. Okay, my 678910 said 4802. 4802. Which is Jubilee Pocket around Mackay. just over 4,000 households, so it's a bit of a smaller one. And we can see that 35% are borrowing and 43% are renting. 37% are actually is the income support for mortgages, 32.9% for renting. Over 59% are houses, 22% rentals, units I should say, and overall we see that the gross investment yield is positive 4.4, net investment yield positive 0.8, and you can see here that the best case scenario is that actually prices could be above zero in 3 years' time, but the base case is a bit of a fall, the worst case a more significant fall. I'd like to show you the scenarios and as they play out. And the point about these scenarios, by the way, is I'm not saying this is a forecast, I'm just giving you a sensitivity range, right? So it could be that somewhere between the best and the base is where it's going to actually end up, or it could be, if you take a more negative view, between the base and the worst. But it gives you a bit of a flavour. There's very little chance, I think, of significant equity growth, even with migration and everything else, particularly in some of these areas. Okay, Rosie said 3041. Okay, so this is Strathmore Heights in Melbourne. There are 5,000 households in the area. 35% own outright, 39% borrow, 25% are renting, and 43% of disposable income is going for the mortgage on average, 29% for the rent. And you can see high levels of mortgage stress at 71% of households, that's a cash flow measure of course, rental stress 66%, and overall financial stress at 54%. And as a result of all that, you can see quite significant falls are forecast over the next 3 years, even in the best case scenario. 64% of houses, 16% of units, and the net investment yield is close to zero. The gross investment yield, which of course is the relationship between price and achievable rental, is still 3.4. It's gone up a little bit from compared with previously because of course rentals have gone up a little bit more than prices in some areas. So that's that one. Okay, what else have we got? PPL says 2166. Try that one. So this is Cabramatta, 16,000 households, and here 27% own outright, 27% borrowing, and 44% are renting. So a long story on renting there. 55% in mortgage stress, 73% in rental stress. That's more than 5,000. And the overall financial stress count is 54%, or more than 9,000. When it's high, they're registered red shaded here. And looking at the scenarios, you can see here that the 58% of houses, 22% of units, the gross investment yield is at 3, the net investment yield is negative 0.5 on average. And you can see here that the scenario suggests that there is going to be a bit of a fall over the next 3 years, even on the best case scenario. The base case and worst case scenario, a more significant fall, and it's all to do with the pressure on households and their ability to be able to navigate the higher interest rate environment, as we discussed earlier on. Okay, so that's that one. Let's see what else we've got in terms of other ones. I saw quite a few questions. Ben said 2119. I'll put that one in. Okay, so this is Cheltenham in New South Wales, small count at 4,000. Own outright 42%, borrowing 41%, a low level of renting. About half are in mortgage stress, 898. But because of the scenarios that we're looking at there, the best case is a minor fall over 3 years. The base case, a bit more of a significant fall. I would highlight the fact again that the gross investment yield is 3.4, but net investment yield is minus 1%. And most houses, 10% units. And the income is on the higher side in that particular postcode, but nevertheless, despite the higher income, 45.9% on the average mortgage repayment, more than $4,000 a month. For the rent, average 33% at $2,990. So it's a very significant factor in the mix. Okay, let's see what else we've got. I saw a few others. 3220 from Rosala. Okay, so this is Newtown, Greater Geelong, more than 7,000 households, 33% are outright, 30% are borrowing, 35% are renting, 92% are in mortgage stress, 65% are in rental stress, and stressed investors at 19%, overall financial stress at 55%, and so we're seeing prospect of significant slides over the next 3 years, even in the best case scenario. 67% of houses, 10% of units, and the net investment yield is minus 0.7%, 3.1% gross investment yield. And you can see there the taxable income and the household census is roughly similar, around 100,000. 38.4% is the average mortgage repayment in terms of disposable income, and the average rent is 27.3% in terms of monthly disposable income. Cameron asks about Cronulla, 2230. Cronulla, of course, in Sydney, 13,000 households, 33, pretty much evenly split. 28% in mortgage stress, 65% in rental stress. Households in financial stress about 43% overall. And because of that, scenarios are a bit negative even in the best case scenario, but more extremely negative if you actually believe we're going into recession. 38% of houses, a lot of units, 52% of units of course, and interestingly 10% are vacant. That was on the census night, so some of those could be second homes I suppose. 3.4% gross investment yield, net investment yield minus 0.1%, and the average household income from the ATO is just over 109,000. So that's that one. Okay, Simon says 5167. So that's in the suburb of Adelaide. So 2,600 households, a small suburb. 29.6 own outright, 45% are borrowing, it's a mortgage belt, 25% are renting, 54% are actually in mortgage stress, 25% in rental stress. And looking at the scenarios, in the best case scenario there's an upside over the next 3 years. The base case, bit of a fall. The worst case, more of a fall. 85.3% for houses, 9.5% of units. And looking at the gross investment yield, it's 4 versus 0.9 net investment yield. Obviously the income is somewhat lower in this particular area. Nevertheless, 36.3% of disposable income is going on the average mortgage, more than $1,800 a month, and the average rental 33.7%, or $1,694 a month. Ken says 2066. Okay, so this is Lane Cove, 13,000, and 25% own outright, 39% of borrowing, 35% of renting, and you can see here the mortgage stress is around 30%, that's more than 4,700. Rental stress is at 50%, and overall stress is more than 65%, and you can see here the scenario is looking pretty sick at the minute, even in the best case scenario, simply because of the pressures there in terms of what's going on. And if you want to see how the pressures play out, the average income here is 143 based on the household census, but 51.7% of that is going on the mortgage repayment on average, which is more than $3,600, and the average rent is more than $2,500 at 37.2%. So that's your problem. It's a significant proportion of cash flow going on the mortgage or rent just for accommodation. And just to make things a little worse, gross investment yield is 3.4. The net investment yield, that's after the various other costs and things, is minus 0.3%. Okay, and RB said 6064. 6064. Okay, so this is Alexandra Heights, and of course in northwest Perth. 11,000 households. 26 own outright, 48% are mortgage, 25% are renting. Mortgage stress is at 70%, rental stress is at 81%. And as a result of all that, you can see here that the scenarios are for falls from the current level over the next 3 years. And if the base or worst case plays out, then they could be more significant. It's also worth noting that the average disposable income 63 to 73, depending on how you measure it, and that means that 38.1% or $1,820 a month typically going on the mortgage, or $1,495 a month typically going on the rent at 31.3%. 86% of houses, the rental on average is 3.7%, and the gross is positive. The net investment yield at plus 0.2 is also positive, but only just. Okay. Daz said 4870. Let's see what it says. He said, I wouldn't be surprised to see a base of 30 plus. Okay. So this is Manunda. How do I say how's that? Manunda, probably. Something like that. Up in far north. 28,000 households. 23% own outright. 35% are borrowing. And 41% are renting. And looking at the income around the 70s, 37.2% the average mortgage at 1,920. The average rental 1,544. 59% of houses, quite a few units, and the gross investment yield is plus 4.4%. Net investment yield is plus 0.7%. As a result of all that, you can see that the best case scenario is a pretty flat story over the next 3 years. A bit down. This is cumulative numbers, so 1.7 over 3 years. But on the base case, it's a more significant fall. So Mitchell and Rachel said 3802. So this is in Endeavour Hills in Melbourne, 8,400 households, and you can see there 33% own outright, 46% of borrowing, 19.3% of renting, and the mortgage stress number is very high. Now this is of course plus or minus 2%, but it's pretty much at the top of the range. Rental stress is also a problem too, and 65% of households are in financial stress. As a result of that, the scenarios are not looking very good. Even on the best case scenario, I think there are going to be falls ahead here over the next 2 or 3 years. And just to add to that, if you look at the household census data, 90,000 per household is what the census reported. 39.9% of it is going on the average disposable income monthly repayment, 2,218, and 33.6% going on the typical rent, 1,869. So pretty difficult really. And looking at the distribution, 87% of houses, so it's mostly houses that you're seeing there. The gross investment yield is 3.4, the net investment yield is 0.4%, so just positive. But these scenarios, this is a typical high growth corridor, I think you'd see here, and unfortunately, I think there's more downside than upside from where we currently are. Nico 999 says 2089. Okay, so this is Neutral Bay in Sydney, 5,600 households there, 23% are outright, 23% are borrowing, 53% are renting, so that's a rental high spot. And it's worth noting that only 9% of houses, 80% of units in this area, 14% were vacant on census night, and the gross investment yield is 3.3. The net investment yield is underwater, minus 0.2. That's because a lot of those property investors are mortgaged. Now looking at the stress data, 71% of renters are in rental stress, so they've got a real cash flow problem. Stressed investors, 60%, more than half of property investors are actually struggling with cash flow on their investment property. They're underwater, and the overall financial stress number is quite high. As a result of that, the scenarios look to me as though there could be quite significant falls even in the best case scenario, and significant falls in the worst case scenario. Income's quite high, of course, 128 to 137 depending on how you measure it. The ATO is individual the census is household, 188,000. But look at this, 41.5% of monthly average disposable income going on the mortgage, $3,484 a month. 33.4% or $2,800 going on the average rent over the month. So significant issues and significant pressures. And Mitchell and Rach says, thanks, very welcome, thanks for the super chat, really appreciate it. Okay, 5170. Whoops, missed 5170. This is Maslin Beach in the Adelaide city suburbs. Now this is a very low count in this area, so I need to warn you that these low counts mean that this is not very predictive insofar that it's a very small number. However, you can see there that 35% own outright, 41% of borrowing, 20% of renting. A lot of people are in mortgage stress, and the overall financial stress metric is 41%. So there is a scenario where there's a small rise over the next 3 years if the best case scenario works out. The base case is a bit more of a fall. And just looking at this, 97% of houses, 11% are vacant, so there might be some holiday homes in there possibly. Gross investment yield 3.7, net investment yield 0.3. And looking at the $63,000 to $71,000 based on the average taxable income, 34.7 going on the typical mortgage at $1,584. The rent on average is higher at 36.6% or $1,670. Okay, so that's that. There were quite a few others earlier on that I can go back and perhaps pick up a couple more. Angie said 4037. I don't have my full chat facility running yet, so I can't display them on the screen, but I will get sorted out. So this is an interesting one insofar that the best case scenario suggests there will be a rise over the next 3 years. So this is actually Eaton's Hill in Brisbane and Moreton, 2,627, so a relatively small count, and 60% of borrowing, so it's a very high borrowing count, 10% of renting, and 23% are only outright. 24% of mortgage stress, doesn't seem much rental stress, bit of stressed investor stuff though, and the overall financial stress at 21. So you'd expect the scenarios to be more positive, and yes they are. So there's definitely some growth potential, not significant, but some growth potential over 3 years on the best case scenario, slightly falling on the base and worst case scenario. And it's houses, 99.4% of houses in the postcode, very little vacancies, so it's a very stable community there. Gross investment yield is 4.5, net investment yield 1.1. Average individual 86,000, average household 144,000. And look at this, 31.6% or 2,581 typical average mortgage per month, 28.1% or 2,292, and that's 28.1% going on the typical rent. Okay. Thank you very much, Nico, for your super chat. Really appreciate it. And great to see that people appreciate the work here. I have to remind you that if you actually want to get a one-to-one deep conversation on postcode, you can go to my blog and contact me there to talk about the sort of stuff that goes on. Okay, now let's just have another little look and see what else is going on, see what else we can find in terms of postcodes. I'll do that one. Do Lane Cove. Not sure I did, so I don't recall doing Lane Cove. I'm going to do it. If I've done it already, I apologise. I didn't keep a list. There are so many coming through. So Lane Cove's interesting insofar that it's of course up in the sort of just outside Sydney towards the northwest. And typically it's been quite a prosperous area. The income is quite high, 140,000 give or take, but they're very high rentals and very high mortgage payments, so 51.7% at 39%, or 37.2%, more than $2,591, and that's 35%. And because of this, there's a lot of significant stress, significant falls, and it's worth highlighting again, units are more than dominating relative to houses in terms of the construction in the area. A lot of conversions, of course, there, as well as older style properties plus new, and a lot of new builds as well. And net investment yields minus 0.3%, whereas the gross investment yields are 3.4%. Okay. See what else I can find. Otherwise, I'm going to come to the end. If you put a question, a postcode in earlier on, it's 3220. There's one there. I'll do that one. You might want to put it again, just so I keep up. Geelong and Newton, 7,350 in the postcode, and 37. So there are more renting than borrowing, but significant mortgage stress 92%, significant rental stress 65%, and households in financial stress 55%. And you can see here the very considerable falls over the recent period. And the scenarios are looking relatively horrid. Now, looking at the mix, 67% of houses, 10% of units, and the vacancy was quite high, so there might be some second homes there. Gross investment yield is 3.1, net investment yield is negative 0.7, and the average income is just over around 100,000, so 38.4%, or 2,520 the average monthly mortgage repayment. The average rent at 27.3% is $1,294 a month, and the result of all that stress is pushing prices to the low side. Steve says 4053. So that's McDowell, 19,000 households in the postcode, 23% own outright, 40% borrowing, 35% are renting, and stress is 1/3 of mortgage stress and 60% for rental stress, a bit of investor stress. Overall, about half of households are in difficulty. As a result of that, you can see that there's a scenario, best case, with a small fall, 7% over 3 years. The worst two are actually more significant falls. 76% are houses, 11% are units, 12% are other types of property. The gross investment yield is 4.6, the net investment yield is 0.7. The taxable income on a household basis is about 110,000, 111,000. And that translates at 37.2% of the disposable monthly income going on the mortgage, 2,476, and the rental 30.7%, or $2,044. So quite significant. And the scenarios obviously are going to be determined by what happens with interest rates ahead. And I wouldn't be surprised to see more mortgage stress in this area in the weeks and months ahead either. Nimo said 2034. Okay, so this is Coogee, 8,700 households, 21% own outright, 23% borrowing, 54% are renting, and 9% are in mortgage stress, but 74% are in rental stress, and the stressed investors are quite high too. So the overall scenario is 62%, which puts downward pressure on prices over the next 3 years, even in the best case scenario. 17% are houses, 70% are units, so it's obviously mostly units in the area. And the gross investment yield is 3.4, the net investment yield 0.4%. Income's quite good, 145,000 based on the household census, but 44.8% of the average disposable monthly income is going on the typical mortgage payment, more than $4,000, and the average rent at 33.7% is more than $3,000 a month. So a very pressurized example there. So Andrew says, can we try somewhere in Tassie? 7250, we can. I do cover the whole country. So this is Riverside in Tasmania, 21,000 households, 33% own, 26% borrow, 30% rent, 66% mortgage stress, 60% in rental stress, 47% in financial stress overall. Scenarios are a fall. I think that Tasmania is going to take a bit of a bath, unfortunately, because of those run-ups over the last 2 or 3 years. Very significant, of course, and now beginning to disappear. The household income is low, about 74,000. So 31.2% average mortgage disposable income payment, 1,560. 28.4, 1,420. And 81% of houses, 10% of units. Gross investment 5.1%, good yield. Net investment yield, one of the best, 1.9%. So Tasmania still has reasonable investment returns, but 25% are stressed investors. Donna, thank you very much for the super chat, and thanks for that and for your presence on the show tonight. Ken says, Martin, is net investment yield net of debt servicing? It's everything. So all the various costs of managing the property, including the interest on the mortgage, maintenance and management costs. Okay, A. Joy says 6025. Okay, this is Hillary's and places around there. Padbury, 12,400. 33% are owning outright. 49% are borrowing, so a lot of mortgages. 70% are renting. 37% in mortgage stress at more than 2,300. 83% in rental stress, and a bit of financial stress as well overall. And scenarios are a bit of a fall over the next 3 years. Best case scenario, more significant fall if you think that rates are going to rise further. 89% of houses, and the gross investment yield is 4.1, net investment yield 0.9. Incomes around the 100,000 plus or minus based on the data there. And so 36.9% of disposable monthly income on the mortgage at $2,500, or 30.6 at $1,993 going on the average rent. Matty says 4214. Okay, another area in Brisbane and Moreton, 14,000 households, 27 own outright, 43.8 borrowing, 28.9% are renting. You can see there that 80% of renters are in rental stress, 15.7% are in mortgage stress. Bit of a scenario fall, maybe 5% over 3 years, best case scenario for houses and units, and more for the base and worst case scenario as rates rise. 79% of houses, and the gross investment yield is 4.7, the net investment yield is 1. The average income per household around 90,000. That translates to a typical monthly disposable income payment of 42.8%, $2,340 a month, or 43.7, which is $2,392 a month. So quite a significant contribution there, and that's one of the reasons why we're seeing quite a lot of the rental stress growing. And I think the bottom line is there's more to come, unfortunately. Edge May says 3073. 3073. Okay, so this is Reservoir in Victoria, 21,000 households, 29.3% own, 32% borrow, 37.9% rent. Significant amounts of stress, 64.5% and 44.2% for mortgage and rental stress respectively. Overall households are in financial stress at 41%, and more on the downside, I think, because of that. So 11.5% over 3 years, or worse, maybe down 30%, best case. Mostly houses, 63.2%, but quite a few other types of property in the area. Gross investment yield is 3.1, net investment yield is minus 0.9%. You can see how many of those areas in and around Melbourne are in negative net investment yield territory. Typical income somewhere between 70 and 80,000, and looking at the disposable monthly income, 44.2% or 2,383 for the typical mortgage, 33.3% at 1,794 going on the typical rent. Okay, and 2284. Somebody's asked for 2284. Let's put that one in. So this is Beau Larue in the Hunter. 5,000 households, 30% own outright, 42% of borrowing, 27% of renting, 53% of mortgage borrowers in mortgage stress, 65% in rental stress, and some stressed investors, so over 45%. So there's a bit of a downside drift to prices in Hunter area around here, maybe 11% down, best case over 3 years. And in fact, you can see a bit of a uptick in year 3. Looking at it, 85% of houses, and gross investment yields 3.4, net investment yield just underwater, typical income around 80,000, and that translates to 43.4%, or the mortgage of 2,288, and the typical rent at 34.5% at $1,819 a month. Watch Wardrobe says 4217. So this is Benoit in around the Surfers Paradise area, 19,000 households, 31% own outright, 26% of borrowing, 42.5% of renting, 29% in mortgage stress, 66% in rental stress, overall financial stress at 44.8. Bit of a fall over the next 3 years, particularly if we get more rate rises. 24.9% of houses, 61% of units, and the vacancy rate's very, very high at 27.5%. Of course, that's a lot of Airbnb and a lot of holiday homes, I suspect. 4.6% gross investment yield, 0.4% net investment yield. Looking at the income, it's somewhere between 85 and 76, so it's around that sort of figure. And looking specifically at the contribution, this is the disposable monthly income, so typical mortgage $2,340 a month, and the typical rental is 44%, which is 2,178. So quite a lot of financial pressure here, and anytime we get above 30% or there, you sort of worry. More than 40, that's a definite leading indicator of pressure ahead. Well, what's the time? 21:19. So we're getting close to the end of the show. If there's a couple more that come in, I've just got time for them. But otherwise, as James says, 5097. We'll do that one. There we go. 5097, Redwood Park in the Adelaide suburbs. 5,700 households, 33 own outright. 49% are actually borrowing, and 17.2% are renting. You can see here that there's very little stress, so that's one of the lowest stress levels that we've seen so far, and that's one of the reasons why there's an expectation potentially of rises if the best case scenario runs. The base case would see a bit of a fall. Looking at the situation, 85% of houses and 9.7% of units. Gross investment yield is 4.2, net investment yield is 0.6, and the typical income is somewhere between 67 and 81, depending on whether we're looking at household or individuals. That translates to a disposable monthly income on the mortgage of around 36.7% at $1,800, or 34.0% at $1,670. Okay. Stuart says 3008, and this will be, I think, the last postcode for tonight. So this is Docklands in the centre of Melbourne. 7,900, and 10% own outright, 20% are borrowing, 69% are renting, massive. 40% are in mortgage stress, but 67% are in rental stress. That's more than 3,700. And a lot of stressed investors there too, so a lot of investors aren't seeing great returns. Very significant falls most likely, even under the best case scenario, worst case scenario, significantly worse. Of course, it's all units, 97.89%. Also, 24.3% were vacant on census night. Now, that could be a combination of second homes, etc., etc., but we suspect that in that particular postcode, there are a lot of people holding property vacant just for the long-term capital growth. Well, good luck with that, based on my scenarios. Gross investment yield is 4.1, net investment yield is 0.3, and you can see there that the average taxable income is around 100,000. And that translates to a typical mortgage payment of $2,400 or 35% of disposable monthly income. Typical rental payment of $2,048 a month at 29.9%. Okay, so I think that will do. I'm just going to switch back to my other screen for a second. So a few closing thoughts from me. The first one, of course, is all of this talk about mortgage stress and rental stress. A lot of people are in difficulty. If you have a mortgage and you're in difficulty, talk to your borrower, talk to your mortgage provider, your bank. They are there. They are obliged to provide some assistance. Many of them will, although sometimes what they offer is a solution more to help individuals rather than really solve the problem. Help individuals in the short term by spreading the payments further, but talk to them. The other point is that be very careful if you are feeling you need help. Just don't Google loan help, what have you, because you're going to find a lot of sites that actually charge for stuff that you don't need to charge for. But there is a site that I recommend, and that is the National Debt Hotline on 1-800-007-007. This is actually, of course, a government-backed scheme, and they are excellent at providing advice and support. And I do recommend that if you are in financial flow difficulty or you've got debt problems, make a note of that number, 1-800-007-007. It is a profoundly good service. I do happen to know that the debt counsellors in Australia have never been busier than they are now, trying to deal with this massive weight of debt that we've got in the system. But it is worth taking that on board, I think, if you need help. I will also just make the point that my blog has more information on it, and there's also the contact or help. If you need to get hold of me, you can send a message via the blog. The details are in the link below. And I also, of course, publish data on Patreon. All of the data that you've seen tonight comes from the Patreon service. You can subscribe and get all of the data set for all of the postcodes that I cover in Australia. Go across to Patreon and sign up if you'd like that. And we send that out about a week after the end of the month end with the latest information before we sort of share the full details more broadly. So you get first dibs on the information that's there, which is, I think, quite important. I'm seeing a lot of people valuing this information at the moment to try and help sort of think through how to deal with the various scenarios that may or may not be ahead. Well, I think we're done. I want to say thanks very much for all the comments in the chat. It's been great to see so many people on, and all the questions and all the postcodes. If you didn't get your postcode answered, send me a message via the blog, and I will, over the next week or so, send you a one-page snapshot if you'd like that, so that you can then see what the story is. And I appreciate your time tonight. Thanks for bearing with me with the microphone issues and trying to get the levels sorted out. I have no idea why my streaming device decided to stop playing ball, but hey, at least it still sent the signal up to YouTube, which was the main thing. I was panicking that maybe the whole stream was dead, but no, it was just the meter that wasn't working. So really, really weird. Also, if you like the post, please remember to make that vote in the YouTube. Share it as well if you'd like to share the information, and check out my other shows. I'll be back now making regular calls and shows. I've got guests lined up over the next few weeks, so watch out for that, and I'll tell you more about next week's guest in a day or two when a couple of other things have just sorted out. Now, before I go, I thought you might be interested in this little story. So this is the old the old doggy cam, Meteor. Oh, she's gone the other way. Oh well, she's come to see me. But Luna's in her bed looking extremely relaxed. She's been there the whole of the show. You'll see that the doggy beds are a bit different now. They've got their own. They seem to like to curl up in them, so they quite enjoy that. But the question is, of course, whether we can get both of them sitting in the doggy bed. I've also not got the steering system set up yet on the cam, so we'll be able to do it next time, and perhaps I'll show you a bit more about the studio as well. But the studio is coming on. It's definitely taking on a bit of shape, and I'll probably make a show on that sometime later. Good girl, Meteor. You can just see Meteor's tail there out the corner. Okay, so that's it. I want to say thank you very much for spending some time with me tonight. Appreciate it. Keep following us and all the things we're up to. We are still covering the Australian markets in the same amount of details previously. Similar constellation of guests, but I'm going to start injecting some broader guests and some broader conversations into the stream in the weeks and months ahead as I continue to build the studio out. And I'm going to be switching to a different platform to be able to control the show and do a bunch of other things. So it's interesting, and I want to say thank you for spending some time with me this evening. So this is Martin North from Digital Finance Analytics signing off. We'll see you next time.